Welcome back, dear students and scholars. We are continuing ASC 350, and today the topic moves from rights to systems. This lesson covers internal use software, cloud implementation, and website development costs. The key point is that software and website costs are not automatically assets. The accounting depends on the purpose of the software, the contract rights, the project stage, and the evidence available. So, even if a project is expensive and impressive, accounting still asks a disciplined question: should this cost be expensed now or capitalized and recognized over time? Our learning path today is very practical. First, we check whether ASC 350 subtopic 40 applies. Then we confirm the internal use criteria, analyze hosting arrangements as either a license or a service contract, separate the project into stages, classify each cost, record the entries, and document the controls. For software, timing is not just project management language. Timing often decides the accounting treatment. In other words, the same invoice may be expensed or capitalized depending on when and why the cost was incurred. ASC 350 subtopic 40 applies to software acquired or developed to support internal operations. This includes purchased software used inside the company, internally developed systems such as payroll, enterprise resource planning, or customer relationship management platforms, and replacement systems that take over from old internal platforms. It also includes certain implementation costs for hosting arrangements that are service contracts. The main question is, what is the software for? If it supports the entity's own operations and is not being built for resale, ASC 350 subtopic 40 may be the correct starting point. To apply the internal use software model, two conditions must both be met. First, the software must be developed or obtained to meet the entity's own operational needs. Second, the entity must not have a plan or substantive intent to market or sell the software to third parties during development. If both conditions are met, the three-stage internal use software framework applies. But if the company is building software for both internal use and external sale, we cannot simply force it into ASC 350 subtopic 40. Scope comes first because wrong scope creates wrong capitalization. Some software paths are outside ASC 350 subtopic 40. Software built for commercial sale or licensing to customers belongs under ASC 985 subtopic 20. Software used only in research and development activities may fall under ASC 730. Software built under a contract for an external customer follows contract accounting. Business process reengineering costs that happen alongside a software project require separate analysis. This is a common real world trap. A software project may be real, useful, and necessary, but that does not automatically make every cost capitalizable under the internal use software model. Cloud arrangements require a careful hosting decision. Cloud access alone does not prove that the customer has a software asset. Two questions matter. Can the customer take possession of the software without significant penalty? And can the customer run the software on its own infrastructure or through a third party host it selects? If both answers are yes, the arrangement follows the software license path. If either answer is no, the arrangement is treated as a service contract and implementation costs are analyzed separately. A login screen is not the same as ownership of software. Even when a cloud hosting arrangement is a service contract, qualifying implementation costs can still create an asset or prepaid cost. Direct implementation costs such as coding, configuration, and direct testing may be capitalized if they meet the criteria. Non qualifying costs such as training, data migration, and general overhead are expensed as incurred. Capitalized implementation costs are amortized over the term of the hosting arrangement, including reasonably certain renewal periods. Hosting service fees remain separate from implementation cost amortization, So the income statement needs clean classification. The software project has three stages, and each stage has a different accounting treatment. In the preliminary stage, costs are expensed as incurred. This includes planning, vendor evaluation, and strategy selection. In the application development stage, qualifying direct costs may be capitalized. This includes coding, configuration, direct testing, and certain direct travel. In the post implementation stage, training and maintenance are expensed. The project file must document when each stage begins and ends. Stage boundaries are accounting decisions, not just status updates from the project manager. The preliminary project stage is fully expensed. This includes choosing the project strategy, defining performance needs, evaluating alternatives, reviewing vendors, selecting software, and negotiating with consultants. Even if the project later becomes successful, those preliminary costs do not come back from the income statement and become assets. That is an important discipline in ASC 350, subtopic 40. Planning may be valuable, but planning alone does not create software ready for use. The accounting answer is simple. Preliminary stage costs are expensed as incurred. Capitalization begins only after commitment. Before a software cost enters the asset account, four gates must be crossed. The preliminary stage must be complete. Management must authorize funding. Completion must be probable based on available evidence, and the software must be expected to be used as intended. Once these gates are cleared, qualifying direct costs may be capitalized. This is why the authorization date and state change date are so important. If the documentation is weak, the accounting conclusion becomes weak too. Only direct qualifying costs enter the software asset. Examples include third party development services for coding and configuration, purchase software modules incorporated into the internal use system, direct employee coding time, direct testing time before the software is ready for use, project related travel directly tied to qualifying development activity, and capitalize interest when applicable under ASC 835, subtopic 20. Every dollar needs support from invoices, time records, project logs, or payroll records. Software capitalization is not a bucket for costs we do not want to expense. Not every project cost becomes software. Training costs are expensed, even when training occurs during development. Routine maintenance is expensed. General and administrative costs are expensed. Overhead allocations are expensed. Most data conversion is expensed unless it directly enables the software to function. Post implementation support is also expensed. This is a useful memory line. A cost can be necessary for the project and still be expensed. Accounting is not asking, was this helpful? Accounting is asking, does this cost meet the capitalization criteria? Now let us apply the rules to Meridian Foods. In 2027, Meridian implements an internal enterprise resource planning system to consolidate finance, procurement, and payroll operations. The project includes planning workshops of $180,000, vendor configuration of $720,000, direct internal coding of $330,000, testing of $150,000, and training and maintenance of $210,000. Total project spend is $1,590,000. The key question is not how big the project is. The key question is which costs qualify for capitalization. The classification gives us the answer. Planning workshops are preliminary stage costs, so $180,000 is expensed. Vendor configuration is direct development, so $720,000 is capitalized. Direct internal coding of $330,000 is capitalized. Pre launch testing of $150,000 is capitalized. Training and maintenance of $210,000 is expensed. Total capitalized software asset equals 720,000 plus 330,000 plus 150,000, which equals $1,200,000. The remaining expense is 180,000 plus 210,000, which equals $390,000. Meridian records two main entries. First, for the qualifying development costs, debit internal use software asset $1,200,000 and credit cash or accounts payable $1,200,000. Then, assuming straight line amortization over 5 years, annual amortization is 1,200,000 divided by 5, which equals $240,000 per year. The annual entry is debit amortization expense $240,000 and credit accumulated amortization $240,000. The asset starts on the balance sheet and then the cost is recognized systematically over the useful life. Amortization starts when the software or module is ready for its intended use, not necessarily when the entire project is finished. In this timeline, the project begins in January 2027 with planning and vendor selection. In March, management authorization is issued and the application development stage begins. In June, the payroll module is ready because substantially all testing is complete, so amortization of that module begins immediately. In November, the procurement module becomes ready and starts its own amortization. Do not make completed modules wait in the hallway just because later modules are still getting dressed. Troubled software projects require impairment and abandonment analysis. Warning signs include reduced service potential, a significant change in how the software will be used, expected major program changes, costs greatly exceeding budget, or evidence that completion is no longer probable. If completion is no longer probable, the entity must assess recoverability and write down the asset as required. Uncompleted software often has little or no supportable fair value, so write downs can be significant. The accounting team should not wait until the project is officially cancelled if the evidence already shows the asset is impaired. Internal use classification is not permanent. If management decides during development that the software will be sold or marketed externally, the project must be reassessed, and from that point forward, software for sale guidance under ASC 985, subtopic 20 may apply. If the software was completed and used internally before the decision to sell, proceeds from sales to third parties are first applied against the carrying amount of the asset. Only after that carrying amount is recovered does the entity recognize a gain. So the company cannot immediately celebrate sales proceeds as profit if unrecovered software cost remains. Now we move to website development costs under ASC 350, subtopic 50. This guidance applies to costs incurred to develop a website for external or internal purposes. The accounting depends on the activity being performed, not simply on the total project budget or the fact that it is a website. Planning, building, designing, populating, and operating a website can each create different accounting results. Server hardware and physical infrastructure are not within ASC 350, subtopic 50. Those items are handled under fixed asset guidance. A website project has stages just like a software project. Planning generally includes defining goals, scope, and technology stack, and those costs are generally expensed. Application and infrastructure development builds the technical foundation and is analyzed under software cost guidance. Graphics development may follow software cost logic when the graphics are integral to functionality. Content development, such as populating pages, text, and media, is generally expensed as incurred. Operating stage costs, such as ongoing updates and maintenance, are expensed unless they add new functionality. The same website can contain both expense activities and capitalization analysis. The website treatment grid reinforces the main rule. Do not capitalize a whole website project as one asset without stage by stage analysis. Planning is expensed as incurred. Application and infrastructure development may allow capitalization using software guidance. Graphics development may qualify when the graphics are integral to website functionality. Ongoing hosting fees are expensed over the benefit period and are not capital assets. Operating updates and maintenance are expensed unless they add new functionality. Each dollar must be traced to the activity that created it. Websites may look smooth to users, but accounting cannot smooth over the cost classification. Project controls protect the capitalization conclusion. IT confirms stage boundaries and module readiness states. The project owner confirms scope and whether completion remains probable. Finance ties capitalized costs to invoices, time records, and payroll reports. Accounting classifies each cost by stage and documents the rationale. The controller or senior accountant reviews the capitalization memo before the entry is posted. Important checkpoints include authorization date, state change date, cost support, testing completion, and impairment indicators. Controls are not extra paperwork. They are the evidence trail that protects every dollar in the software asset account. That completes our lesson on software, cloud arrangements, and website costs under ASC 350. The key takeaways are clear. Internal use criteria decide scope, hosting rights decide the license or service contract path, project stage decides expense or asset, readiness starts amortization, and controls support professional judgment. In the next video, we apply ASC 3050 through practice questions, impairment cases, an IFRS bridge, and a limited SAP note. Thank you for studying with me. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues who want clear US GAAP learning.